Entrepreneurship and business ownership are hot topics these days when there's absolutely no certainty around income and job security. Job satisfaction, work-life balance, and building multiple income streams are what all top entrepreneurs advocate. But they are on the other side of a long journey and have experienced both the scars and the stars of business ownership. Approximately 50% of new businesses fail, and the statistic is similar for first-time business owners. So, are you thinking of a startup, buying or selling a business? Then you have joined the right podcast today. Hello from me, Roshni Gajjar, and welcome to episode 8 of Lift as We Rise. Today, I'm speaking to founder and CEO, Aspira Business Brokers and Advisors, Orlando Rivera, and he joins us from New Jersey in the USA. Orlando, welcome to you, and I'm really keen to speak to you today.
Likewise, thank you so much.
Yeah, we kind of connected over Evan Carmichael talk or live stream, and Orlando was really struck by your deep knowledge around business brokering and most strikingly your passion around the work you do. So I hope that today we can share this with our listeners.
Sounds good.
Okay, so business broking. Tell us about business broking and what does Aspira Business Brokers do? What is the story?
Yeah, good question. So business brokers, it's funny, in my neck of the woods, most people don't even know what a business broker is, and most business owners, unfortunately, don't know what it is. And a business broker is what it implies, right? So we broker businesses, but I'll clarify that. So most people understand Wall Street, traders, they're selling, trade, equity of an ownership of a business. But we do that in Main Street. So we help privately held business owners to value their business, put it in the market confidentially, sell the business to a qualified buyer. And likewise, on the other end, we help buyers who are looking for profitable income generating businesses that are already proven and established to be able to find those, acquire them, and buy them. So that's what we do. We buy and sell privately held businesses, typically in what I'm going to refer to as Main Street for now, is probably businesses with about $1 million or two and below in gross revenue. And then we also serve the lower middle market is another term we use. So the terminology, I think sometimes it's a little off for some of us, but the lower middle market is, under $20 million.
Right. So Orlando, you were a founder, so you didn't buy into an existing business. Tell us around the Aspira story. And what I find fascinating, you're not only a finance professional, but you're also a legal professional and an engineer. So this is a massive knowledge base. Yeah, very keen to hear the Aspira story. Share it with us.
Well, there's a lot to cover there in the personal background, but in terms of how Aspira was formed, I had no idea this profession even existed, and this role out there to serve other business owners existed until I was invited to sit on a board of or serve as a director for a startup, a nonprofit, to help other business owners and entrepreneurs learn about entrepreneurship. And later he named it the National Business Investors and Entrepreneurs Association. In any event, in our conversation, he suggested that I consider becoming a business broker, similarly because of the passion and background and knowledge I have and my desire to serve other entrepreneurs. And I had no idea what it was. I investigated it, and I joined a brokerage firm here called Tannenbaum. At the time, it was Tannenbaum and Lilask, but it was one of the largest and most reputable brokerages in the region. In fact, it was founded in 1946. I couldn't find any other brokerage in the country that existed even as long as they did, continuously. So in any event, I joined Tannenbaum and became a top producer very quickly and became the director of operations and sales within about a year. And then I basically took control. I was in the driver's seat. I was the broker's broker, helping the owner improve the value of the business, producing great results. But unfortunately, somewhere along the line, things didn't work out the way they probably should have. So I moved on with the idea that I would provide a service to other business owners that had a greater value, and that is where Aspira came about. The name of Aspira is actually a Spanish word I use. I'm Puerto American, right? Born and raised in Jersey, but my family is from Puerto Rico. And so Aspira, or Aspira, is for us means to aspire, and it happens to be also the root word of aspiration. So it was a perfect name for us. And ultimately, what we do at Aspira is to help other entrepreneurs, business owners, or entrepreneur-minded individuals to reach their aspirations. We understand that it's not just a transaction, that there is a deeper meaning and purpose why someone's making a move in their life. And we're ultimately trying to serve that deeper purpose for that business owner or entrepreneur to help them reach their aspirations, whether they're moving on to the next big thing of retirement, or whether they're trying to get into their first business.
Yeah, so Orlando, businesses have always interested me. I come from a family of business owners, and kind of as all children in those environments do, I had to do my duties, and my weekends were spent helping my parents. And what I found was that, any business owner, small business, family business, it becomes part of your life and your lifestyle. And what struck me most at that time was, my dad, who was the business owner, and my grandfather before him. What was so important to them was the support of their friends and families to enable them to wake up, show up, and go through the challenges every day. And I'm sure as a founder, you found that too.
Yeah, if you mentioned the difference of buying into one or founding something, I founded it because I just have a new way of looking at things, a different way of looking at things that I think most other professionals don't see it. I think a lot of business brokers like the traditional way of doing something, and I'm looking to do something very differently. And I'm willing to shake things up. I'm willing to do something that may look embarrassing or just be, by peers. The peers may say, that's not how it's done, but I don't care. Can it provide a better value? Can it deliver a faster transaction for the client, better results for how they look at it? And that's what I care about. So ultimately, I have a 10-year vision on that. And yes, entrepreneurship is a very difficult thing. Business ownership and being a business owner, it's a 24/7 thing. You never stop thinking about it.
Yeah, Orlando, and while we're having this conversation, we've been through a really interesting year. Many people have lost their jobs. Many people are trying to find a more secure source of income. And interestingly, there are also professionals who've come to the realization that they want to try something else and they want to get back into their creative mode. So people are starting to look at the idea of setting up their own businesses. And as you've alluded to, it is a journey. And it's one of the most difficult and complex decisions that one can make. So with your experience and the work you do, how do you help clients to make sure that they are buying the right business at the right price and based on the right information? Take us through that process.
Yeah, well, thank you. So the first thing that we look at is the individual. Again, focusing on what that individual's goals are and what resources they have going into this. So if they wanted to become a business owner, you have to have the conversation of whether this is the best option for them. Now, generally speaking, I'm a big big endorser of going this route. It's rather than starting your business, which can be very painful and difficult because you're doing everything. It's a slow and painful process. The next thing that someone might think about is getting into a franchise. That seems to be very popular, especially since franchise brokers are out there really pushing and promoting getting into a franchise. So that concept is, okay, let me get into a proven model. I'll invest my resources into it and start a brand new one. I'll start a brand new, coffee shop, donut place, restaurant, whatever the franchise is. And they at least think they have this resources, the systems, and support to make sure that they're successful. But that also requires a big outlay of expenses. And it takes a good amount of time to return that money that you invested. The next thing, which I think is faster and cheaper and less riskier, and thus what I call smarter, is to buy an existing business. So you can potentially buy an existing family-owned business or franchise run business, talk to the owner and ask them if they're interested in selling their business. And many times they're interested in talking about that. I would still recommend having what I call a deal team or professionals to help them to make sure that they don't, step into a trap or either side, right? Just do something that just doesn't make sense that can hurt either one. So buying a business is, for me, I think, the smarter approach. Now, I also realize that in 2020 and into now, you're absolutely right. I've noticed many articles pop up that, again, accelerated what was already happening. A lot of people who are thinking, maybe I'm tired of working for my employer. Maybe I'm just frustrated that the direction they're taking is not the right direction. You can see the writing on the wall. Maybe you yourself feel like you're at risk because of your age or your experience, that you may, be replaced or let go sooner than you expected. There may be a number of reasons, and ultimately you always have that fire in you that says, I want to have control over my own future. So if you have those desires, then you're going to, move into that direction. A lot of times the push, as we've seen, was more powerful than the fear of the risk stepping out. And so now I've seen a lot of people step out and use whatever money they had to start a business from home, especially if it's a service or advisory business. It's a lot easier to just provide your services. If you have a phone and a laptop, you can probably do that. But again, I think you can accelerate that even as a better option of buying an existing business, because that business you can look at and you can evaluate, okay, it has existing income, what we call cash flow, right? It produces free cash flow to put in your pocket. You can pay your taxes, you pay your debt service, you can pay, for your own personal living expenses. But you can also assess everything else about the location, the condition, the employees, the type of customers, and you can evaluate more accurately what your risk is going into it, peg the price, and then make that investment based on the return you're looking for that particular opportunity. So again, it's the smartest way. Now, how long does it take to get into a business? Might be a next question. If you're thinking about becoming a business owner, maybe if you're already working, you're still working right now, or you're not working and you're kind of left at home. I think all of us have more time. So I think it behooves you to explore, firstly, do a kind of a self-assessment of where you are, because it takes a certain type of person to be really successful in business. And so that's what we'll have to evaluate and guide our clients. We actually in 2020 developed a program we call Leadership to Ownership. And Leadership to Ownership will be an information product course that we will publish at some point very soon, hopefully sooner than later, where we help someone figure out, what that path looks like from becoming a leader. And that, what I mean by that is you're a W-2, over here, a W-2 employee, you're hired by an employer, you're paid a salary or an hourly rate, you're working for someone else, and you recognize you have experience, you have skills that you were able to produce increased revenue or efficiencies in your employer's business, and you recognize you can do that for yourself now. And so you know you have those transferable skills and that confidence that you want to transfer into becoming an owner, the boss of the business, calling the shots, and you're ready to take on that responsibility. So leadership to ownership will be something that we'll put out there. We'll talk, we'll help others dive deeper into that first step, figuring out whether business ownership is really for you.
That's such an important point that you've raised, because as much as you were talking about people wanting to make this decision about becoming business owners or entrepreneurs because they want more control, I found that you actually have less control. The uncertainties are greater, and most certainly the uncertainty around cash flow, revenue models are uncertain. And with what we've experienced in the last year, I'd like to ask you, Orlando, what people who are looking to buy businesses or enter into the business world as owners or investors, that due diligence process, once you've made the decision that, right, this is the road I choose to go down, Tell us through that exploratory process. What should people be looking out for, and what criteria can they start applying to identify the right business?
Yeah, so first thing is you want to manage the conversation. There's a certain flow to the deal. I call it certain momentum or deal flow well, I actually don't call it deal flow. It's a certain momentum to the conversation, right? You want to keep a certain level of tension with the counterparty that you're working with. So you need to make sure you understand all the different steps and how long you should be in each phase before you're kind of hitting that red line where the deal's probably not going to work. So when you go in, understanding the process, again, I recommend having advisors for sure. So the one global facilitator that works best is a business broker, business intermediary, an M&A advisor. Those three terms are referring to the same person, same roles, but we tend to use them at different levels of complexity. So as a business broker, as business intermediary, would facilitate the process, understanding the order of things, and we'll talk about that. And you need to be able to evaluate properly. So typically, when you're having a conversation with a counterparty, you're exploring the, number one, the motivation of selling or buying. Once you have that established and you say, yeah, we want to have this conversation, let's move forward, there's no paperwork up front. It depends on what's happening. If the business is already represented by an advisor, typically will require it to vet the other party. So there's a kind of a vetting process. Again, if I have a business owner I'm representing, I'm qualifying the buyer to make sure that they're really motivated to get into this, not just playing games or looking around. So the qualifications and establishing the qualifications and motivations are important. Once that's established, typically we have what we call a letter of intent, and that's a non-binding agreement that allows both parties to initially in writing memorialize what the purchase price is, what the terms of the deal, how they're going to structure it, how long the buyer has or the seller has to get through this process, among other really important things. Once that's settled and they agree, then you dive into the due diligence. Typically, it's a paper chase. You request things like your income statement or your cash flow statement or your balance sheet, things like that. You'll ask for legal documents about, the lease that the business has or any contracts they may have, or there's a sensitive balance between seller and buyer because the seller doesn't want to have a competitor in their hands. So there's a little bit of an art there as well in negotiating what we're getting and what can we get to be able to make a decision. And once we go through all that, there's a lot of interaction too between the buyer and seller. So we're asking questions to understand the financials and to understand the story behind the business. And we're also looking for the opportunity for either party, right? So the seller wants to make sure that they have a really good candidate here, that they're not going to waste their time. The buyer is looking at their opportunity for themselves, that not only will the business produce the income that they expect when they take over, so it's dependent on that individual, it's for them, it's what they can do with it. On top of that, they're looking at what opportunities they can grow. So I've never seen a business buyer buy a business solely because of its current cash flow. They've never said so, but I can tell you that a buyer will price it based on its current cash flows and assets, but they're really motivated by what they can do and the potential that they bring to the table. So we have to make sure that those opportunities are there and can be identified and actually capitalized on by the buyer. Again, that's something that's very tricky for a lot of acquirers that very often they don't see that. And once all that's done, then the due diligence is done. At that point, or concurrently, we're trying to get financing or trying to get third-party approvals. So if the buyer's not a cash buyer, they need to get financing. Very often it's traditional bank financing. We have a program here called the SBA. The SBA has financing that allows, it gives greater affordability to buyers to acquire businesses. That's on one size. And the greater sizes, there's a combination of different financing, including private equity and such. And then, of course, it's, attorneys jump in to deal with the paperwork to bring us to closing. Sometimes there's accountants helping with the due diligence or helping with their clients and the buyers forming their entities and supporting that effort. Typically on smaller deals, I recommend there's a deal team of at least 4. There's the business broker, the attorney, the accountant or CPA, and the financial advisor. Typically financial advisor for the seller, but and the buyer, they may have other partners they need to bring in to make sure that that process works for them and that they close on a deal that is profitable and successful for them.
You've raised some really important points there. So in the strategy work that we do, we often get aspiring business owners come to us to ask, do you guys do business plans? And we say, yes, we do business plans, but our business model is to build sustainable businesses. So we'd like to help you plan what you're going to do with the business you're owning to ensure that you can actually deliver to promise. And it's interesting that most people are more interested in the document and hesitant to go through the appropriate planning processes. So what you're saying about getting the right advisors up front to help you with that business modeling, that business planning is absolutely crucial.
We call that integration work, integration planning, or integration services in the back end. So once you acquire it, you have to integrate that business into your new ownership or a combination of businesses. And again, that side of things, depending on what size you're talking about, have varying levels of success. Planning is essential. I agree with you. Planning is essential. Now, I don't know how you approach it, but I'll make a comment on planning, on putting plans together, right? I think it's absolutely required, but it's almost, it's not as useful as you think. So the first reason I think a business plan is helpful is to help that person organize their thoughts. So they have everything thought through. They've asked every question of themselves that's important to their success. They went through all the different paths and contingencies in that path, right? So they're doing proper planning helps them to prepare and iron out all the details so there's no gaping gaps or blind spots in their rear mirror, right? And that's where you come in to help them with that. The other requirement that they'll need it for is for financing. So we'll often need a business plan for sure when getting financing, bank financing in particular. So those are the 2 reasons. Now, the reason I say it's almost, after that, it's required but almost useless is because once you start getting into the real world, the business plan starts to unravel and it's no longer really applicable. You've adjusted so much so fast that at some point you had to constantly adjust and you have a different plan, you're in a different place than you totally expected or thought you would even be in. And that's one of those skills that, again, that we're looking for, or I would recommend that a business owner has, the ability to solve problems and to adapt. But that's my point on business planning. I'm glad you mentioned that. What's your thoughts on that?
Yeah, so from our side, the business is nothing except a shell until you put life into it. So for me, the planning process is really interesting and it can be a fun process because you start putting heart into the business and you start putting a character to the business. In other words, what does a business plan mean at the end of the day to your market? What do you want to really deliver to your customer? What is your end goal as a business? What is your culture recognized as? And so as you become quite creative and your vision becomes more informed, the more excited and engaged you become with this business that you're trying to buy. So my next question, Orlando, is probably the critical one. And we've all kind of put an offer to purchase on a car or a house or looked at share prices on the stock market. What is the right price to buy? Take us through that decision-making process and that valuation process.
We spent about a half hour just talking about that not too long ago, right? Valuing a business is probably one of the most important aspects of the deal, right? And I think that's one that takes a lot of experience and practice. I mentioned valuing a business is both a science and an art. The science is clearly what you can track and it's replicable. You look at the financial statement, you see the income, you make adjustments off of the income based on, again, how you're going to operate it, or even the adjustments you would need to understand free cash flow, or even on financing. So it's slightly different, but you're looking at that cash flow number, and then you're approaching it as an income approach. That's typically what we're looking at. You're valuing a business on the income approach, and what that future income looks like for that person. As long as that individual buyer sees the future income that they can rely on, they will then extrapolate from that risk rate, discount, or, there's different ways of valuing it. Some more complicated, like the discounted cash flow approach. You tend not to use that one a lot of times with these smaller businesses. It's not as relevant or useful because it requires a lot of information going into it that a lot of times these small businesses don't even have. So that's the sign. So you can look at the number and say, okay, based on comparable businesses that sold in this industry at this size, in this region, even in some cases, in some types of businesses, then you can come up with a multiple. Typically, back of the napkin, casual conversation, everyone's referring to the value of a business by using a multiple. They may say a 1 time, 2 time, 3 time, 4 time multiple, or 2.5 time, whatever fraction they want to use, multiple of the business. So for example, if a business is producing $200,000 and they say, look, I've seen comparable businesses in this marketplace at this size, so for 2.5 times multiple, then that's a $500,000 valuation of the business. Now that's the science. But the art is really the story behind the business, the connection between the owner, the seller, and the buyer, the level of trust in getting the deal done. And again, the opportunity for the buyer. If the buyer can see a much bigger opportunity for future income because of what they can bring to it, they think they can double the business for some reason, then they're going to clearly assess higher value to that for them. Another buyer may approach this, may look at the same deal and realize that they don't have as much resources. They don't really see much of a path for growth. In fact, they're more concerned about contraction or shrinking in the business once they take over. Then they're going to give you a different multiple. They're going to maybe give a much less multiple evaluation of the business. Again, I wouldn't use multiples as the best way of valuing a business. It's more of the shorthand. There's a much more complex background to it. But again, there's a science and the art. So how do you value a business? There's no one way of looking at, to give you an answer, right? Because we don't have a business example in front of us, but not only are we looking at the business, we're looking at the buyer. So those things you have to evaluate. I think I can get you in the right direction. If you look at the business, determine the proper cash flow. Now, please do it correctly. Don't look at the financials incorrectly and use the wrong number in which you're going to then look at other comparable sales and then apply that. That could be very helpful.
So the numbers are the best source of data that one has, and often those numbers are prepared by an accountant or an auditor who are independent. So there's some trustability and dependability around that information. Orlando, when we're looking at multiples and when we're looking at the numbers, there's revenue or the sales generation capability, there's the profit model, and perhaps in a manufacturing environment, the gross margins. And then, of course, the key to all businesses and business continuity is around cash flows. So those are the 3 metrics that you have, and stacked up against return on investment. How can those 4, let's call it ratios, be used to come to the most appropriate valuation for the business? What is your experience tell us?
So again, different sized businesses, those financials are going to look very different. So a lot of times these smaller businesses, even under $10 million, just don't have good accounting systems or accountants. They don't have good financial controls, and they don't really hire the professionals to do the job that they could be doing. A lot of times the financials are based on tax returns, and that's an obligatory, duty that they have to track their income and expenses for the purpose of tax returns. They're positioning their financials for the sole purpose of reducing their tax liability and paying less taxes, right? Legally. So that's the first thing you really have to be aware of. Going into this, you're not going to have like an audited statement with these smaller deals. Just not going to happen. The way I like to look at it is, if you can visualize, like you just did, if you can visualize the income statement, you look at revenue, you look at maybe cost of sales or cost of goods, you look at the profit margin, look at certain expenses, and you see the bottom line, right, their income. I like to tell the story and explain this by looking at one at a time and then talking about the differences. So for example, your income, your gross revenue, gross sales, right? Gross receipts or total sales. That, you have to evaluate that by itself before you even get into percentages. So profitability and margin is a criteria for a buyer, especially many private equity investors and buyers. But you look at the quality of that sale first. So I'll give you an example that hopefully will illustrate the understanding of the value of that income. Not all income is the same. You can have one business doing $1 million in sales, top line, and another one doing the exact same thing. Both are in the same industry, same size employees, same region. But this one has big turnover. So they literally have to 60% or 60% of their customers are not repeat, they're brand new. Only 30% is repeat. Whereas if you look at this side, it's the opposite. Maybe 60% of their customers are repeat customers. And not only that, they have contracts in place that are 5 years out. Which business immediately do you see as having higher value, right? The one that has locked in contracts for 5 years making the same revenue. So this cash, this earning, this revenue is much more valuable than this one. This business now is much more valuable. Likewise, you have to go deeply behind each aspect of that income statement to determine. And again, at each stage, you're going to look. You're going to take it up and say, I give it a higher value because of this. I'm tweaking up the value because of these items. And likewise, you're looking at different aspects and bringing down the value. And then you're also looking for that bottleneck, that one thing that really is the trigger for them all, right? What is at the heart of the business? The financials will give you a story. They'll tell you how the business is being run and how it's being managed, so you can understand it from that aspect. But again, the qualitative aspects is really the tricky part. And again, I just gave you an example of how you have to dive into those, so that I couldn't tell you necessarily, what percentages you would look for. But for sure, there's a textbook format that you would use and saying, look, I want this profitability and margin. I know that in this industry that the bottom line should be this dollar amount. And then when you don't see those matching up, you can dive deeper into those and understand, okay, maybe something's wrong with the expenses. Can I fix that myself? Can I come in here and make it more profitable? Or is it something that I can't repair? Right? And if I can't repair it, then how am I going to look at the value? So I hope that answers your question.
Yeah, so, to those who are new to this and don't have the benefit of having a finance background or an accounting background, these types of things that we're talking about and taking for granted can be quite daunting, right? So that due diligence process that you as a business broker support, that accountants, lawyers, and bankers get involved in, so that value proposition is quite strong, is a really, really important piece of work. And that's part of the planning and the decision-making process, because often people look at the business from the outside, and from the marketing and from what you see, it looks good and it looks like it's really profitable, etc. But until you ask the difficult questions to really understand what's the story behind the numbers, you're not going to really pick out what the red flags are that you need to be aware of. And Orlando, what one finds, irrespective of whether you're buying a small or a family business or a large M&A deal, is that you don't know how much money you have to invest in realizing your vision and your plans until you get into the business. And I guess in the work that you do, you also factor in the capital investment that you're going to have to put in to take it from opportunity to realization as part of the valuation model. Am I correct?
Correct. Absolutely. And you're asking a leading question because but I think you made a really good point that a lot of the people maybe listening here are not financial experts. So some of the terms we're using may not be understood and may not even understood why that's important or how that all plays together. So the first thing that you mentioned that I thought was really important is you have to ask the right questions. And if you don't know what questions to ask, then get help. And so I think, you don't have to do everything by yourself. It really is smart. It's best that you don't do everything by yourself. I'm trying to figure out right, myself, how I can delegate more personally. But again, I think that's a trait that a lot of people think that they have to do. They have to figure it out themselves. Really bring in professionals who can help you understand what questions you do need to ask that you didn't even think about asking. And then once you have the answers, how to interpret it correctly. That's what we call to use your deal team.
So Orlando, we've looked at the income statement, we've spoken about cash flow and creating a more predictable model. And I specifically didn't talk about valuation based on assets for a reason. And I'd like to hear your views and thoughts on this, is that we're going into business models that are becoming more and more digitized. And we were talking about it just before we started the webinar, that the balance sheets are starting to contain more soft assets as opposed to the hard assets. And for those who aren't used to these terms, hard assets we refer to as land, buildings, machinery, plant, equipment, etc. Whereas intangible assets or soft assets are your intellectual property, your software, your digital assets, and your IP. How does valuation work in these types of changing spaces? Is the balance sheet and the asset base still a good base to look at as far as valuations go?
You know, that's a great question. You really, I don't know if you can't approach it by saying I want to value the actual tangible assets and then the intangible assets and then add them up. It doesn't work that way. So when we talk about the income approach, whether regardless of whether, for example, here's an example of we can use this to talk about maybe an e-commerce business, right? It's a digital business. It's all online. Your real estate is your website. It's your domain. Your distribution may be eBay or Amazon. Now you're dependent on that distribution platform, right? So you built a business. You're doing $800,000 in top line sales. Your margins, maybe you're making 60%. Then, after all these expenses, you're netting your dollar amount. When we talk about, that's an example of an intangible asset, right? There's nothing physically you can hold on to that, for example, a lender will hold as collateral. So there's no collateral. There's only inventory, and the inventory may be housed somewhere that no one knows, right? It could be in someone's garage, or it could be in Amazon's warehouses, right? So fulfillment by Amazon. It's a good example. I love online businesses, by the way. So this is a good one to talk about. And a lot of people are excited about this. And there's been, for many, many years, Amazon's really promoted this type of FBA type businesses and e-commerce. Valuing a business that has no assets, no tangible assets, or even just light intangible assets. Again, we're looking at the income approach. What that means is we're looking at what is the income to that buyer. So they want to know what their income might be for this particular business for the next 3 years, 5 years. Hopefully they can go further than that, but 3 to 5 years, right? They can foresee income for them with the business, running that business and owning that business. So number one, that business income, once you know how to do the math correctly, you have to then figure out whether it covers, if you're taking on debt to acquire, does it cover debt service? If it does cover debt service, to cover the debt that, for example, a seller wants to sell it for $500,000 in this case, right? They net 250 for some reason, and we're just making this up, and they're looking at a 2-time multiple in this case, 2 years, 24 months of their revenue, then $500,000 million asking price. The buyer will have to look at this and say, look, if I can get the income out of this and I can sustain that for at least 3 years or more, at least 3 to 5 years, hopefully in perpetuity, because they'll keep adding different product mix and keep doing what the other person does to constantly make their revenue, because they're building a brand. That person built a brand and a following and a customer base that someone else is going to quickly take advantage of. So that's why they're giving that multiple, just smarter. Now, when they do that, if the income covers the debt and you see what's left over and that income looks good to you, then that's the value. And if it doesn't even cover debt service and the person's asking price doesn't even make sense. So that's the first thing you need to figure out. And I call that a buyer price test. based on, look, if the buyer's going to come in, they got to pay themselves a salary. What is that salary? What's left over is what the business can do, can provide as debt service or as additional income to the business. And that's the part that you would have to evaluate. And so if you, for some reason, see that $500,000 debt with $250,000, so if you cover that $500,000 debt in whatever term, 5 years, 7 years, 10-year debt schedule, that also impacts it. Interest rates will also impact the value, and the availability of financing too will impact it. So once the buyer figures out they can, oh, I can support this with $100,000 a year, the other $150,000 I can put in my pocket, then it's a go.
Orlando, you've referred quite a lot to factoring the repayment obligations. Talk to us about structuring the purchase decision and also the various financing options available.
So the purchase decision, again, depends on the individual buyer, right? So if it's an individual or a partnership or even a company acquiring another company's assets, it's really, the acquisition is made based on personal interest. I can find you, a lot of people come to me and say, I'm looking for a business that will generate this income in this region, at this size, I have this much available to put down, I have this experience. But what you find out is that there's a lot of personal emotional connection to this. The desire to be in this market is an emotional thing. They want to be in it because they see the opportunities, right? They're excited about it. It has nothing, so I always say, I can find you a business tomorrow and we can close on it tomorrow that fits all your criteria. What we realize is that they're not really excited about it. So that's the first thing. And in terms of financing, there are 4 major things that you need to evaluate for yourself to determine whether you can get financing on your side. First is your experience. Second thing is your liquid cash available as a cash injection into the deal. The third is your credit. And then the last, in no particular order, is your collateral, right? What's your net worth? Can you collateralize debt? Can you support the debt with good credit and good collateralization of net worth? So that you show as a strong borrower from a lender. Those are 4 things that are the pillars of the borrowing side, the borrower side of the lending process. The other side that a lender will care about greatly is the asset you're buying. As you mentioned, if there's a lot of tangible assets, you can collateralize it. That will help for sure the deal. If there's historical 3 years consistent in revenues in the business, it's been or going up, a bank would love that. If it's going down, that's going to be a problem. That's going to be a flag for the bank. You may see the opportunity because you see the story behind it, but banks don't care so much about the story. They want to follow their underwriting requirements and their criteria. So you need to make sure that both the borrower and the assets being bought, both combined, will qualify for those lenders' requirements in order to get the financing.
Orlando, give us maybe your insights and the trends that you're seeing about people who choose to go into business ownership as a sole owner and the considerations around perhaps finding a trusted partner and deciding to go into a partnership model. And what are the pros and cons about those 2 options?
Pro and con, a solo going out there, I see that more often in the smaller deals. It's just easier. You have more control. You're the only one calling the shots. The negative is you don't have support. So with a partner, you have more assets, more collateral, more hands on deck to manage the business. You can leverage both of your skill sets and your expertise, especially if they complement themselves, right? One may be the great salesperson, the face of the organization, and then the other person can be really great at the technical aspect, product development, design, whatever development they're doing. So the Steve Wozniak, I guess the Wozniak and Jobs kind of scenario, right? So you can monopolize on that, but the negative is on the partnerships that you be really careful with. It's like a marriage. So you need to be like best friends. You need to know that you're going to stick it out through all of the ups and downs, the pain points, the arguments that's going to happen, the disagreements in direction, and that you have a way to work through it. Otherwise, You may have that's just like marriage. There's one stat out there that said, I think 50% of partnerships fail, just like 50% of marriages do. So those are the pros and cons of coming in as an individual versus a partnership. And it depends on your personality type.
Yeah, Orlando, in the startups and the M&A work that I've worked in, certainly you find that the fundamentals and the data and the information and the due diligence processes could show up all the right indicators that, yes, this is the right purchase decision. Often, though, the final decision of whether to go yay or nay is influenced by chemistry between the transacting parties, between business partners. And so that I found is quite an important ingredient in ensuring that what is the right model? Are you absolutely working on a relationship of trust and comfort? Then go for it. But if there's a hesitation around that, then maybe give them some critical thought before finding a buddy to go and do it with. So we've spoken quite a... Sorry, Belinda, proceed.
I probably should clarify that partnerships tend to work really well with startups, tech startups in particular, because of the complementing skills. So statistically speaking, partnerships are great for the startup. Acquisition, I see more solos going at it. And you're right. I think everything's built on trust. We talked about that too. You know, business is done between people. It's not between brands and logos. Our logos never talked and coordinated our ability to come together every day to share and to teach, you know, others. It was really about our passion, our individual aligned interest. And so business is done between people and people, and trust is that currency in which you're able to grow your business with your team, with your customers, collaborations, you name it.
Yeah, I think that's a podcast conversation on its own, the principle of trust. Yes. So Orlando, from the work I've done in M&A, corporates, asset management, you realize that you should never fall in love with your assets, nor with any one particular investment, right? So by implication then, in any business ownership, entrepreneurship journey, there comes this day where you know this is the time to sell and to move on to different things, or to allow the business to grow in someone else's hands. And that is a really, really difficult decision if you've built this business ground up, if it's a family or a legacy business, or it's something that you're absolutely passionate about. So from the seller's side then, what is the right time to sell? And how do you ensure that you receive fair value for your business?
I'm so happy you asked that question. Because a lot of business owners hold on to the last minute and it's just too late. A lot of business owners, when they come to me, they already decided they want to sell their business. There's no planning in place. And so I have to work within a very short period of time to help package them and prepare them for the market, coach them through it, position it in our marketing, and attract the right buyer. That's really not the best way to do it. So to answer your question, I have a really simple answer. The moment as an owner, you started daydreaming about what life would be like for this business or outside of this business ownership, you're daydreaming about other things. You're not really excited about being a business owner anymore. And let me tell you, that happens really early on. You know, business owners will daydream about it and think about it very often, but they will push it down, and then a year or 2 years or 3 years later, all that stuff swells up. And what happens is that over the 2 or 3 years, they're thinking about it. They're taking away their passion and their energy away from the business. And I like to analogize that the heart of the business, the success of the business, is directly correlated to the heart of the business owner. If the business owner's heart is fired up, then that business is fired up and it's really strong and doing well. But if the heart is starting to lose that passion and desire for business ownership, their role, their leader, their team will see this, their customers will see this, and it will reflect in their income, and it will reflect in the business, and thus it'll reflect in the value of the business. So instead of waiting to the last minute, I recommend it's really simple. The moment, if you ever daydreamed about what life would be like not being that business owner anymore, then I think that's the day immediately you need to reach out. I would, talk to your accountant. Be careful though, because a lot of accountants, unfortunately, will look at the book and say, okay, here are the multiples, we can do the math right, but that's half the story. So they're not quite getting the valuation right. I had one person come to me where their accountant said that the value was around $900,000. I came in around in the 400s, maybe 400 to 475, some at the highest, 475. Now, unfortunately, the business owner recognized common sense that didn't make sense. And so, she kind of thought through this and said, I recognize that you have a better understanding how this is going to be sold and whether there's a buyer for something like this. So number one, get evaluation. For us, it's a very light cost. It's a loss leader because we want that relationship. So we'll be even cheaper than certified valuation experts or accountants who do that because we, of course, welcoming the conversation to get started. It doesn't mean we're trying to sell your business right away and pressure you. But again, there's a lot of answers. There's a lot of questions you should be asking at that time. We will cover them. We will answer them for you so that now you know there's different paths as a seller and which one do you want to do. For example, as a business owner, once you daydream about this, that means something's happening. You need to reach out to us. We'll value it. We'll talk about the different options, and then you can then decide whether are you going to put more effort into the business over the next couple of years to show the potential and to capture higher value and equity out of that business. On the other end, you may decide and recognize that there's an opportunity cost. You may say, this was great conversation to be had in a safe place that's confidential. And you may recognize that there is another opportunity for them that they think that they want to get started right away. They think that they start now, that's 3 years from now, they can be in a much better place, financially, but also in personal satisfaction and joy and happiness. So they may decide right there and then to sell or do some type of blend of the two. But once you realize that there's these options, you can make a decision and move accordingly and make informed decisions rather than running away from the fear of perhaps, number one, your business is like your baby, it's your family. You feel bad that you're potentially putting your baby up for adoption. Maybe you feel embarrassed or fearful that it's like you're a failure for some reason. Sometimes I couldn't make it. Has nothing to do with it. It really has nothing to do with it. A person who's working at a job can give 2 weeks notice and move on to the next best opportunity. The business owner, unfortunately, is what I call it, they're in a golden cage. They're caged in, and they feel like they can't go anywhere. They're kind of like a caged tiger. Yeah, it's beautiful, it's golden, it's making money, it's their identity, but they're not really fully happy in it. And so I think you have to recognize that there is a way out. And I think our conversation here, talking about this, literally just opens up the conversation that there's someone out there that can actually help you value your business, capture that value, and go to market with it. A lot of business owners, I just talked to someone from a major accounting firm, one of the top 4 accounting firms in the country, and he was just telling me, confirming what I was talking about in terms of the lack of awareness, in that he was part of a very large manufacturing association, providing content and resources. And one of the members of the association, as a manufacturer, came to the president and said, look, I'm going to close my doors, and that's it. The association president said, why don't you sell it? And they had no clue. They had no idea what this person was talking about. Looked at him like he had 2 heads and probably said, what are you talking about? I can't sell it. They just have no idea. And so I think just talking about this and letting everyone know, number one, on the business owner side, that there is a business broker that can help them capture the value of their business. They need to be informed. Don't guess. Just don't do it. And don't lead with your emotion in this case. It's going to misguide you. It's going to take you in the wrong path. This is one of those cases where it's not intuition. It's more guided by fear and other emotions that are not really helpful. On the buying side, on the business owners, the people out there who are not business owners and are entrepreneur-minded, never owned a business, this should be definitely an option for them. Consider buying an existing business so they can accelerate their success.
Orlando, I could speak to you for a lot longer, and we are running out of time. So let's maybe end up on this one. You've got a willing buyer, you've got a willing seller, you've agreed on the valuation, you have an existing owner who's a little bit disappointed and disillusioned that they have to hand this business that they love so much over to its new owner. And this new owner is excited, but also anxious about this big decision that they've made. Can you share with us some thoughts on success stories that you've seen, or the key success factors, let's call it that rather, around business owner transition?
At what
to
stage?
ensure that it changes hands effectively, efficiently, and in the customer or the client's best interest. Share with us some stories where you have seen success around the criteria there.
You know, quite often there is a lot of success because these are easier managed businesses. I think you were talking about once you've successfully closed on the transaction and ownership has been transferred. Is that what you're referring to?
That's right.
Okay. So typically an owner has to understand they have to stick around for quite some time to transition the new owner into their role as the ownership, right? So take over the driver's seat. There's a portion of this that's free, right? There's no charge to the new owner because you've already been compensated for the value of the business. It's your job now to train them. That will take weeks or months, depending on the complexity of the business. And sometimes there's a lot of other options where the buyer the new owner will hire the previous owner in a consulting role or some type of compensation so they can manage the key parts that keeps everything together without them losing it. So, and in bigger deals, that's very, very common, right? 1 year minimum, 3 year max, 2 years might be the average where an owner should expect that they're going to have to stick around. We're talking about the bigger deals, right? We're talking about the multi-million-dollar deals, especially with private equity firms. But with individual buyers or owner operators, it's a much easier transition. And it's usually very quick and very successful because, in fact, the new owner prefers that the other owner is gone so that they can, be the sole owner and not everyone, can get confused by who's the owner. But yeah, I think I would say much higher success rate in the acquisitions post-closing, post-acquisition for smaller businesses because they're owner operators and they know what they're getting into. It's directly correlated to the decision-making of the purchase, the pricing, as well as the management of the business. For bigger deals, as you know, since that's what, the space you're in, the integration is hit or miss. More often than not, I think integration doesn't go the way they expect. They don't realize the total benefit they hope to get out of it. And so that, again, very often acquirers think they're more than qualified to do it themselves. They're very smart. They have extensive backgrounds. They have teams of their own. But rarely do they also think about, oh, I need a team on the other side. Maybe I need an objective team to help with integration. And that could increase their success. So again, Main Street, lower middle market's how I refer to it. And so Main Street, very good, very easy, I think, in that sense. And then lower middle market and above, it starts getting more difficult in integration and realizing the total gain and benefit as you get the videos.
Thank you, Orlando. I mean, whether it's a small family or a large corporate business, I think the underlying principles are very similar, and the topic of integration, I think, requires a separate conversation. I mean, that is a key part of looking at the culture and the leadership models of the business, and particularly the systems that look at business processes and efficiencies. and how are those transitioned and sustained. But Orlando, we have run out of time. It's been an absolute pleasure speaking with you today and fascinating to hear your insights. Sometimes as professionals in this space, we take our knowledge and our experience for granted. And we forget that there are millions of people out there who are just starting the journey into something that is very daunting and exciting at the same time. But it certainly could do with help of trusted advisors. So thank you, Orlando, and I hope that we find an opportunity to work together on possible deals between B2B business transactions, let's say in South Africa and the US, who knows?
That would be wonderful. There's a lot of investment from outside in as well, and both ways. We can definitely work together.
Absolutely, and I look forward to that. Theo, thank you for helping us with the tech today. And being a South African and a proud one, I'm going to end off with a quote from Elon Musk. He says, starting and growing a business is as much about the innovation, drive, and determination of the people behind it as it is about the products that they sell. So remember that as a business owner, you are a wealth creator. Remember to lift others as you rise in your entrepreneurial journey so that your ecosystem can thrive. Till the next time, take care, goodbye, and it was lovely spending time with you today. Take care.